This is the first video in our course on applied financial statement analysis, and this is going to talk about Unit 1, which is essentially a recap of financial statements. We would have probably studied a little bit about these financial statements in some of our earlier programs, and we're going to kind of quickly recap that because that is going to form a framework of the overall understanding on how financial statement analysis follows. Primarily, the agenda during the course of this set of our videos would be in Unit 1 would be around basics of financial statements. What are the various financial statements? A quick understanding on balance sheet, profit and loss account, and cash flow statements with respect to also individual items and what are the various line items here. So we are going to discuss the line items here. When I say line items, we'll look at live examples of companies and discuss each of the terms that come across these statements as we go along, right? Secondly, we're going to also do a short exercise on linkages of financial statements so that we know the impact of decision making on all these financial statements, right? So when a company makes any kind of decision, which of the financial statements changes, how does it change, what is the overall impact of that on the business is what is going to get covered here as well, right? So primarily the objective of this entire unit is to one, go through and recap very quickly the three financial statements, quickly understand what is the impact of decision making on those, and then look at some Indian companies and their examples and try and kind of gauge how do these numbers stack up, right, for those companies. With reference to those companies, we'll get more data, more clarity about some of the line items, which we may not have covered as yet, right? So that's what is going to be the agenda of this particular unit. This is going to be broken into multiple videos. The first video is going to start with basics of what financial accounting and financial statements are, and then we take individually the balance sheet, the profit and loss account, and the cash flow statements. Now, what is accounting and why is it important? Now, accounting is the process of identifying, gathering, measuring, and communicating the financial information about a company's operations. So you have to find out the data, find out what data has to be covered, then you have to gather that data, measure the data, and then communicate it in the format, a certain framework that everyone finds easy to comprehend and understand. It is essential to business decision making and monitoring of the activities of the business. Two main purposes thus for accounting are to report the financial position of the company, how is the company doing, and then to assess the performance of a company vis-a-vis a defined period, let's say last year or this year. So is the company improving or not improving, right? So both these data points kind of come and get measured. One of the most common metrics of performance measurement is the profit that the company makes at the end of financial years, right? So that's the yardstick by which most companies get measured. You could also look at yardstick like sales, you could look at yardsticks like cash, you could look at yardsticks like assets, and finally, the most common yardstick is profits because the purpose of businesses is assumed to be making profits, right? So that's the broad spectrum of what is accounting, why does it become important, and how do we go about kind of looking at these data points. Now, when you're looking at a particular company, you have to understand also the concept of what is called as a financial year. Right now, you will have to eventually break down the performance of the company in terms of periods. So you either take a monthly performance or a quarterly performance or a half yearly performance or an annual performance, right? A financial year is nothing but any 12-month period used for accounting. There is no hard and fast rule on what 12-month period has to be used. Any 12-month period could be used. Any continuous 12-month period has to be used to be considered as what is called as a financial year. This may or may not coincide with a calendar year. So it is not necessary that it has to be January to December of a particular year. Different countries follow different financial years. US usually follows Jan to December. So most of the developed nations kind of follow this. India, on the other hand, follows something like April 1st to March 31st. Generally, most Indian companies follow this. That doesn't mean all of them have to follow. You could have companies that follow an accounting period of October to September. So October in one year to September of next year. In this calendar, you will see the year starts in April. So quarter one becomes April, May, June. Quarter two of the financial year becomes July, August, September. Quarter three of the financial year becomes October, November, December. And consequently, quarter four of the financial year becomes Jan, Feb, March of the next year, right? So if this was 2015 and this was 2016, what is commonly called as a financial year is financial year 2016. This is the quarter one of 2016. This is the quarter two of 2016. This is the quarter three of 2016. And this is the quarter four of 2016 financial year. So the concept of financial year is important to be understood. When we say Q1 financial year 2016, that is typically April, May, June of 2015, because most companies in India follow the period between April of a year to March of the next year. So let us revalidate this. If this was 2015 and this is 2016, essentially when we say financial year 2016, this would be from April of 2015, and that's 1st of April 2015 to 31st March 2016. That's the financial year. This here is going to be quarter one. This here is going to be quarter two. This one is quarter three. And typically you could write FY16, quarter two FY16, quarter three FY16, and this would be quarter four FY16. Now, that does not mean that other companies cannot follow the different financial years. Consequently, this here would become quarter one FY17, right? So from here, this portion is FY17 that has started, right? That doesn't mean, as we said, however, that a company cannot really follow another financial year. If a company is following a calendar year, it will be from January to December. Companies could choose to follow July to June. They could choose to follow October to December. So if a company is following, let's say October to September, sorry, then the period that will get established is this is going to be quarter one, and then these 3 quarters of next year are going to come in. Quarter is 3 month periods, right? So quarter three, quarter four. Essentially, that's if a company is following an October to September accounting year, right? So that's how accounting years or financial years are kind of told. For our purpose, most of the times we'll find that about in 90% of the companies we'll see April 1st to March 31st as the financial year as we go along, right? Now let's look at these three statements or financial statements that get created and the respective usage of these three statements. So we have three of them. We have profit and loss account, we have cash flow statement, and we have balance sheet, right? As we understand this, basically, the premise here is that a profit and loss account is going to tell what a company earns through business and what is spent to kind of procure that business. So earning versus costs is going to come in the P&L statement, profit and loss statement, also known as the income statement. This is also called as the income statement, right? Then we have something called as the cash flow statement. Sometimes and we will look at what cases those are. It is possible that the profitability of the company, the sales of a company, the spending of a company is not exactly cash in nature, right? Any money coming into the company versus money going out of the company, and here we are talking about cash as such, coming into the company and going out of the company, is recorded in the cash flow statement. That's the use of the cash flow statement. And as we understand this further, we will get more clarity on these statements and what is the requirement of these statements. And finally, you also need to know what are your liabilities or obligations in a business. So if you have to repay someone for certain goods or services procured, or for funds taken from them, that is a liability. And any resources owned by the company, tangible or intangible. Tangible means what can be seen, which have a physical presence, like a building. Intangible is what may not be seen. For example, a brand value. Or for example, a company may have patents or licenses. Take for example, a radio company or a telecom company. A telecom company like Airtel will have licenses. Now, these licenses are not physical assets, but they own this license. That's an intangible resource, right? So that's your balance sheet. The use of these three will become clearer as we go along, understanding the requirement of these three and how do these kind of fit into our overall scheme of understanding financial statements. Let's now understand what is the concept of using these three and how do these three give us interesting information in addition to what we already have, right? Now, let's first understand which of these are periodic statements and which of these are at a point of time, right? When I say at a point of time, it's like now. Whereas periodic is, for example, for a year, right? So whenever you look at things like profit and loss statement, you never say the profit now is 20 crore. You would say the profit for the last quarter or for the last year is 20 crore, right? So this is definitely a periodic statement. Similarly, if you look at the cash flow statement, you never say that the cash at this point of time, cash generated this point is X amount. You say the cash flow over the year into the company was this much and outside the company was this much. So this again becomes a periodic statement, right? On the other hand, the balance sheet of the company tells you the position of the company at any given point of time. Remember, you're looking at liabilities and assets here. So liabilities is like, let's say I have taken loans. If money is coming in because of the loans, that part of coming in during a period is recorded in the cash flow. But the exact amount of money that needs to be repaid has to be at a point of time. Now, at this point, what is the money that I have taken out as loan? That is what is the balance sheet going to tell us, right? So by nature, the balance sheet becomes like a snapshot, or in simple terms, the balance sheet, if I could use simple analogies, this is like a picture or a snap or a photo that you have taken, right? So this is a stock statement. It is at a point of time, at this instance, on 31st March, on 28th February. Essentially, that's how you will create the statement. Whereas if you were to use a similar analogy here, this is like a video. It is over a period of time, right? It's over a period of time. So unlike here, where you're taking a picture at a particular instance, here you're creating a video for a period, right? That's what periodic statements are. So you go from point A to point B in a periodic statement, but at point A you will have a balance sheet and at point B you will have a balance sheet, right? Any point, any given point of a time, the company will have a balance sheet. But usually your P&L and cash flow is for a period from 1 year, for 6 months, for 1 month, for 3 months, whatever period we are taking, that could be taken, right? So how does it work now? Let's try and recreate this. Let's say you have the balance sheet of a company as on March 31st, 2015, right? And you have another balance sheet as on March 31st, 2016. Now call this point A and call this point B. If you do nothing in between these 2 points, point A and point B are going to be exactly the same. If there is no business, these are exactly the same. But usually, in going from point A to point B, the company would do certain business, right? The company would have performed certain business. All these business transactions are recorded in the profit and loss statement. Any business that you have done and going from point A to point B will be recorded in the P&L statement. Now, the business that you're doing may or may not have involved using cash, right? You could have, for example, you've sold something, but you have not received the money as yet for that. That's a possibility, right? So business transactions will not take care of that. Business transactions would just say, I have created this much, I have sold this much, and this is the profit I have made on that. Whether you have received the money for that or not is actually a cash transaction, and all cash transactions are recorded in the cash flow statement. So cash flow is from point A to point B. P&L is from point A to point B, point A to point B, but balance sheet is both on point A and point B. And you have basically one financial statement, you have two financial statements, you have three financial statements, and you have four. Four here because two are the balance sheet itself, right? Given any three, you can calculate the fourth because that would appear in the confluence of these three financial statements. All three of them give different understanding of the business. Balance sheet typically talks about what is the financial health of a company at any given point of time. The profit and loss statement typically talks about what business you did during the year, and the cash flow statement talks about what cash you generated, if anything, during that particular period. Why are these three important? What is the information that is best retrieved from one statement but not from another? We're going to look at that as we go along. But that's the broad premise of how financial statements look like, right? That's a quick recap of what we just did. So balance sheet is as on a date, balance sheet on another date. This is point A, this is point B. In going from A to B, business transactions that the company has done are recorded in the P&L statement. Cash transactions that the company has done are recorded in the cash flow statement, right? An example of a cash transaction is the company giving a loan to someone. That's not necessarily a business transaction, right? That's not necessarily in terms of sales and costs of the company. So that'll get recorded in the cash flow. Obviously, because it gets recorded in the cash flow, it also flows into the balance sheets. But P&L statements and cash flow statements, to that extent, are periodic statements. Balance sheet is a stock statement. It's at a point of time, right? That's about the balance sheet, P&L, and cash flow. We will obviously look at each one of these in respective details as we go along, in more details as we go along, right? Before we kind of close this particular section on kind of recapping the financial statements, it's important to understand what is known as reporting standards. Preparation of accounting information and its presentation on the financial statements, right? Any kind of information is generally guided by what is called as GAAP. What is GAAP? Generally accepted accounting principles. Now, it's necessary to have these generally accepted accounting principles is because otherwise I can report something in some fashion, you can report something in another fashion, and that creates distortions, right? So that's a simple example could be for example, I buy 100 markers and I buy 100 markers and sell 80. Now, which 80 do I account for? So if I bought 100 and sold 80, do I take the first 80 or do I take the last 80? There is a possibility that the cost of these is different and thereby there is a possibility that the profit I book on these are different, right? So unless you kind of clearly demarcate and say that only the first 80 have to be used or only the last 80 have to be used, there is going to be a sort of a discrepancy or difference in the way companies report data. So it is necessary to have certain set of principles that are generally accepted by everyone, and typically it's prevalent on the geography in which the company is incorporated. So for example, in India we have what is called as Indian GAAP. In US we have something called as US GAAP. And now, because of discrepancies in these as well, we have something called as the IFRS that is coming in, which is called as International Financial Reporting Standards, right? So, International Financial Reporting Standards. And what is the use of this is because each country may have a different accounting standards, and in a globalized world, if you have a company operating across multiple geographies, it becomes difficult to compare companies in those geographies to different companies that are multinational companies, right? So for example, let's take for example something like Procter and Gamble. It's an FMCG firm, worldwide presence. Now if you're comparing a Procter and Gamble to Dabur, which is an Indian firm, both the firms exist in India, but they could be using different accounting principles, and it'll become difficult to kind of put them in the same basket unless you use a certain concept of generally accepted accounting principles. The word now, in a globalized sense, is moving towards IFRS, and most accounting standards globally are also converging towards the tenets of IFRS. Adherence to this makes the financial statements of a company comparable with other companies in the same geography. If you get IFRS, then it is comparable to the way IFRS applies globally. So you can compare an Indian company to a European company if both of them follow IFRS in terms of their principal reporting that comes out. Right? Reporting standards thereby become necessary. We don't need to get into nitty-gritties of reporting standards because that's a job primarily for the accountants, and at the MBA level, we're not really required to get into that discussion. But we do need to understand what are the major issues or major differences between probably some of these, or at least understand when we are comparing two companies that they are not following different accounting principles, right? That's the primary task on knowing what different reporting standards exist. That's what we cover in this particular section. Next section starts discussing about the balance sheet. Thank you.